Let's talk about the thought process for the statement of cash flows in the operating, investing, and financing activities. All right, so the general rationale here is that cash flow is generated through financing activities. We raise money through debt and equity, right? We issue bonds, we issue stock to purchase fixed assets through investing activities, which are outflows, right? So money comes in through debt and equity, it goes out through investing activities. So we purchase machinery, equipment, warehouses, which then boosts cash flow from operating activities, which those would be inflows. Now, obviously, you have outflows and inflows in all three categories, but this is the normal, hopeful, positive business trend, right? Obviously, you need outflows for debt and equity to pay them down. You need inflows from fixed assets when you sell them, or you don't need them, it just happens. And then you will have outflows from operating activities when you have expenses in operations. But we'll see those in 1 second. This is just a great outlook. This is why we're doing what we're doing, right? As a company, you are, let's say, Spotify, and Spotify raises money by going public or issuing debt to purchase machinery, equipment, computers to then boost income from operations, which is their subscription service. Let's look at our cash flow classifications here. We've got our three categories, and I would definitely memorize these for sure. I would definitely memorize. Now, some are more intuitive, right? So selling products, sure, that makes sense that it's from operations. However, paying interest on debt, this is one that always kind of throws me for a loop in terms of why that would be from operations as compared to, I would think this is more from financing, but hey, there's a reason for it. For paying dividends on common stock, this is a financing related activity because you are incentivizing people to buy your stock, which helps you finance, right? So with debt, why do people want to buy your bonds and thus give you money? Well, because maybe you offer a good interest rate, right? And then why do people want to buy your stock? Well, they either want to buy it because they think it's going to appreciate in value, meaning they're going to make money from their investment, or because it pays dividends, right? They just get paid cash out. So just some interesting ones. I'll go through them all though, just to recap it all. So selling products makes sense, right? That's from operations. Collecting receivables, that's an inflow from operations. You're just collecting your own money. Purchasing inventory is an outflow from operations because you need to buy inventory to sell. Paying vendors, pretty simple outflow. Purchasing supplies, this again is a pretty standard operating outflow. Paying taxes, while we don't like doing it, we have to do it, and that is an operating outflow. Purchasing or selling trading securities, so either inflow or outflow, but it's not an investing activity because it's trading securities, and we will elaborate more on this. See, it's all connected, right? Everything in this test is connected. We'll elaborate more on this in our financial investments section. Collecting interest on an investment. So this one as well, you might think, okay, maybe this is an investing activity. However, nope. Collecting interest and dividends are actually operating activities. So these ones I would focus on memorizing more. These ones should pretty much come to you. Paying interest on debt is going to be from operations as well. Selling long-term assets, if we are Spotify and we're selling all our computer machinery for whatever reason, that would be an inflow from investing. And what would be an outflow? Well, if we purchase computers to run our algorithms and servers and host all the songs and everything that everyone streams. Financing, borrowing funds through debt, pretty straightforward, right? That's how we finance, that's how we raise money. Outflow would be paying the principal on the debt, so paying it down. Issuing common or preferred stock is an inflow from financing activities. We talked about the dividends. Repurchasing stock is going to be an outflow for financing because we're paying money to repurchase our own stock. And lastly, prepayment of debt or paying debt extinguishment costs, another outflow from financing. So our cash flow statement provides all of this information and more. If you've heard of the direct versus indirect method, which we'll get to, those are two different ways of preparing the operating section. Investing and financing are always going to be prepared the same way. They're always going to be pretty straightforward. It's operations that get a little funky, and we will see that going forward. All right, so just a quick tab on non-cash flowing activities. These could be easily asked as questions as well. They'll try to trick you. When we record depreciation, amortization, or depletion, no cash is changing hands, right? Whenever you're trying to think about a journal entry, or you're trying to think about something in the cash flow statement, does the journal entry include cash as a debit or credit? Well, for these accounts, for these transactions of depreciation, amortization, depletion, nope, there is no cash changing hands, so it does not belong on the cash flow statement. And then recording income of equity method affiliates. We will see this in our consolidations section, but this is a non-cash flowing activity because it is treated as a return of capital. There's little tricks to see there. Here is another graphic here. We're not going to spend too much time on it. This is basically what we saw, right? So we've got our operating activities, financing and investing. Here are our inflows. The cash pool is just the money we have sitting around, right, in our big bank account. Here are our examples. Take a look. Definitely memorize this. Test yourself. Make some flashcards, and you'll do super well here.